Very good morning. I think y'all can hear me without any interruption. And also, I'm sharing the screen. This is, we were continuing our discussion last week. I think we are very much at the tail end of this discussion. The topic, economic analysis of financial regulation. We can continue the topic that we were discussing over the last 2 weeks, and we will start the new topic for discussion today. Before I start taking you through the topic that we are discussing, any question and any clarifications that you all want, and hope that you can see the screen as well, the presentation screen. Okay, you can put down your questions if you have anything, if you want any clarification. So we will start our discussion. In fact, we have come up to the point where we discussed about disclosures, and we stopped to the extent after discussing briefly about consumer protection, right? So disclosure is, you very much aware now that it is not only the regulatory financial intermediaries regulator, central banks or monetary authorities, but at the same time, disclosures could come from the Securities and Exchange Commissions. These are stock market or the equity market or the debt securities market governing authority regulators. But at the same time, even insurance regulators like insurance ombudsman, these type of positions also could come and impose some regulatory requirements in terms of disclosing your financial positions periodically, right? So these are in effect across the countries. When you see the consumer protection, this is more or less a new area that got, really important attention from all policymakers, particularly after the financial crisis, right? So this financial crisis has enabled financial markets, the participants, stakeholders, also in the light of consumers, and also looked at their rights from a broader perspective rather than limiting often prevailed rights of financial intermediaries and the systems. So the consumer protection expanded with number of acts being enacted and expanded during this period. So that is also an area where you probably see some importance gained with recent developments. Then you see competition-related restrictions. You know that the financial intermediation has certain elements that need to be looked at. That's mainly arising from asymmetry, right? Then, of course, possibilities of adverse selection and moral hazard related consideration. So, in effect, if you let a kind of a free wheel on competition, right? So what happened there is there's a possibility of moral hazard is increasing. So it's incentivizing taking a more risk. So to say that the people or the financial intermediaries would take more incentives in the form of risk taking. So to avoid such possibilities, there are certain elements of regulations was introduced to minimize competition in the form of moral hazard creation. So to say that even the branching kind of restrictions prevail in the past, but subsequently the branch office and things like that has naturally kind of gone out of the fashion, simply because it's itself creating a cost structures for the financial intermediary when they want to manage additional branches. But now the system facilitate more efficient handling of reach to the clientele. So to say that you have all these ATM arrangements and of course partnership with other established organization, even to the extent that you are familiar now with the banks collaborating with even supermarket chains, and some supermarket chains have the banking apps. So to say that the competition being more or less brought in with the cost element and economies of scale factors being considered. So to say these elements have promoted information technology development, ICT, IT related developments. Then of course now the internet and online banking arrangements. These are kind of created a new dimension into the competition. But then some elements of restriction in the form of asset concentration. That means you cannot lend all your portfolio into one type of assets. We talked about these things, for instance, agriculture-related loans, trade-related loans, tourism-related loans, right? At times when those sectors get influenced by other economic activities, you probably see their survival becomes very challenging. Okay, so these elements being looked at, but clearly limiting competition also has disadvantages, mainly in the form of cost structures as well as efficiency related consideration. These are very common elements that everybody would argue. But the competition in the financial intermediation, financial markets being looked at from the perspective of addressing the concerns of asymmetry, adverse selection, and moral hazard possibilities, right? So to say that you've been always encouraged to diversify, always encouraged to maintain adequate risk exposure, not over risk exposure, to address so-called principal agent problems, and also to say that single ownership limits, asset diversification, branching, yes, you can say, but now being, as I was saying with ICT and other related developments, that's not necessarily fashionable in today's context. So these were the elements. We can move on to very important aspect, micro versus macro prudential supervision. Any question before I move to that point? Right. So your silence says that you understand most of the things, and if you still want to clarify anything, you can send me a message so to clarify any points. So we will move on. We are discussing about macroprudential and microprudential supervision. Yes, the microprudential and macroprudential is very much similar to microeconomics and macroeconomics from a perspective, right? So what you are basically seeing is generally prevailing the supervision practice, particularly during and prior to financial crisis, was microsupervision, microprudential supervision, where the focus is safety and soundness of individual financial institutions. You look at Bank A, Bank B, leasing company C, right? Finance company D, insurance company X. So whatever you take there, you look at that particular institution, individual institution. So micro. Your focus is with respect to their balance sheet, their exposure, whether they have exposed too much to one asset class, okay, whether they are exposed to too much to foreign financing, what happened to the financials, the financials, mainly the balance sheets, when you give a shock, 10% depreciation, adjustment to interest rate. So you look at from the perspective of that particular financial institution. Okay, so this very much individual specific. They look at the health of that financial institution. Okay, but the focus of microprudential, yes, still continues. We have to look after the individual financial institutions' health, but more in terms of what's happening to the industry as a whole. Okay, where the focus has shifted more towards safety and soundness of financial system in aggregate, macroeconomics in aggregate. Right? So here they are looking at not one particular financial institution, but the financial system as a whole. They look at what happens because financial institutions are now interlinked to the extent that there is no financial institution that does not have a financial linkage with rest of the financial industry. Everyone has a linkage with one another. And often that does not limit to the boundaries of that jurisdiction. Let's say it's not only restricted to Sri Lanka. It goes beyond Sri Lanka, outside your borders. So what matters here is, end of the day, the entire financial system's exposure for possible risks. Right? So to say that, what happens if the exchange rate depreciates substantially? The entire financial industry has an effect. Their balance sheets become weaker if the entire financial system's exposure to external financing is high. Because you generate your resources, bigger share of your resources in domestic currency. But if your resource generation is in foreign currency, yes, with depreciation, not only you have your liabilities increase, but also your assets also increase. So then you have a natural hedge. Exchange rate movement being hedged by your inflows as well as your obligations. Both sides you have. So you can see that financial intermediation or the financial system has the inbuilt safety measures. But to see that, you have to analyze this in aggregate, not only by looking at one particular financial institution. Similarly, what happens to the interest rate structures? When your interest rate, your home interest rate structure, not only that, you also have to look at global interest rate structure. Today, to that extent, financial intermediation is interlinked. What happened when the interest rates in US increases, or even a signal of expectation to increase? Now that happens. You probably go to Google and type tamper tantrum. It is nothing but US was signaling their willingness to gradually phase off quantitative easing programs. What is quantitative easing? Money supply programs. Money supply in the form of buying assets from the financial market, government securities, whatever. Okay, so to say that, it's an indication that they will in the future gradually phase off their participation in the market. So that itself has created shock waves across global financial markets, where funds, those were easily investing in emerging frontier and developing economies, started pulling back to their bases, like their own bases in the advanced economies, particularly to the US. So we had that outflow during that period. Other countries had much bigger outflows during that period, right? So there's a kind of element where the broader macro perspectives play a role in exposing the entire financial system into risk. So what you are basically seeing here is when you look at the macroprudential perspective, you look at not only the financial institution, but the entire financial system in the aggregate. So you can see it here. So what happened when you look at the financial system as a whole and that financial system's exposure? As I said, foreign financing exposure. Similarly, the exposure to tourism sector as a whole, particularly for countries who rely on tourism. So if the entire tourism sector is underperforming, the assets in your books in the form of loans to tourism related would not perform. So all become non-performing loans. When all become non-performing loans and the entire financial industry is exposed to that significantly, you find that the entire financial system face the risk of tourism-driven shock. So to say that you gradually look at, similarly the real estate. This is the same thing happened when they look at the subprime mortgage crisis in the US and in the advanced economies. What they have seen is the firms who had higher exposure to real estate and subprime were the ones who suffered most. It's like, again, a medical kind of consideration. People who have kind of a perennial, if not exposure to other diseases or the other severe ailments, are more prone to get COVID infected. So it's a kind of, macro perspective that you are looking at it now. So to say that you are trying to address the entire system's exposure. You pool, okay, bank A's exposure to tourism, bank B's exposure to tourism, C's, likewise entire financial markets exposure in Sri Lanka to tourism. So if that's the case, you are encouraging the entire financial industry to focus from a perspective of diversifying their portfolio rather than further extending facilities for tourism related industries. Right? To avoid a particular shock being felt by entire system. Similarly for agriculture, similarly for real estate, you can name anything, there's a limit for exposure. These limits varies from country to country, system to system, but still it has to be not exposed too much. So the macroprudential is the more focused approach to look at safety and soundness of financial system in the aggregate. Microprudential supervision that focuses on safety and soundness of individual financial institutions. So the fashionable buzzword during the recent times is the macroprudential supervision. Right? So you have to take this. It's a very important element. I know this being repeated at few exams also. So anybody who is keen to see the developments in terms of some lessons from financial crisis, you can put this also as one of the lessons from financial crisis, recent financial crisis, the focus in terms of macroprudential supervision. The safety and soundness of the financial system in the aggregate compared to safety and soundness of individual financial institutions, that is microprudential supervision, which was the fashion, if not focus, prior to the financial crisis. And what is macroprudential? You can explain. So these are the developments you see across the global financial system in recent times. Any questions? Right. So I'll move on if you don't have questions. So to see that there are a lot of legislations being passed in the case of US. So I'm not going to name them, but just have a feel what are these legislations. So you can get a kind of understanding how the financial intermediation evolves over the period of time. Focus from where to where, right? So reform, recovery, enforcements, that's become more towards the latter part of this. But beginning, it's basically the establishment. In the middle, you see a depository institution deregulations. Those who like to facilitate more free kind of environment. Okay, so the expansion in that sense further continues in recent years, right? Bringing in even consumer protection into the equation, as we were discussing. So to say this is some feel into how the financial intermediation evolved to great extent in these advanced economies, particularly lead up to the financial crisis and immediately then. And subsequently, there are a lot of other developments. We will come to those as we move on, right? Then with all these developments, you talk about bank failures. You see these periods where bank failures were very common. Yes, the financial crisis that we are looking at is 2008-9. There were spikes here. There were a number of banks in US failed during this period. In US case, the banks, you probably see, you can state banks, national banks, international banks. State banks are the ones restrict to that particular state alone, like a province in Sri Lanka, only to that province. Its operations are concentrated to that state. National, across the states, entire US. International, beyond borders. So there are a lot of smaller kind of financial intermediaries, yes, but international banks also failed during this period. Then you see in early 80s up until late 80s, these were oil shock, inflation shock. There are a lot of developments during this period where the interest rates increased. As a result, some of the financial intermediaries failed in US. And prior to that, you see the numbers, those were a Great Depression, 1932, yes, during that period. So you see, with all these developments, still a substantive number of financial intermediaries fail. Right? So there is no magic formula that you can prescribe to prevent bank failures. That's why the focus in terms of deposit insurance, safety nets, all kind of things become more concerned of policymakers in recent times, right? And to great extent, the failures were limited in emerging and developing economies because there are a lot of efforts to preserve, and those financial intermediaries also not necessarily that much risk taking compared to some of the banks in developed world. With all these systems, they still take substantive risks. And looking at this, again, you see the assets that they have lost during these periods, right? Billions, right? So this is in millions of US dollars. It's close to about 400 billion in 2008, like the assets because of 150 odd, no, actually a lesser number, but subsequently the filing of new bankruptcies increased the number to 140, 157 in the red line. That's what you are seeing. But at the same time, you can see the assets under these failed institutions also reducing with the numbers. But it's interestingly, it's returned into the normal trajectory where you don't see much except very few, like 2, 3, 4, that you can see from a normal perspective. But at times of crisis, see the peak. That's where you try to avoid crisis. Crisis really kind of, create panics, create vulnerabilities, expose your entire systems. Then you see the crisis in early 80s I was explaining in the graph. Apart from the inflation, oil price driven interest rate increase, also to say that there was a saving and loan and banking crisis in US that led to some of these bank failures. Okay, at that time also there were indication that financial innovation and new financial instrument facilitated increased risk taking, right? Then of course the deposit insurance also created moral hazard, because you know there's a godfather, somebody is there to protect you, so you are not taking adequate concerns, precautions with respect to your money, right? You deposit it and keep away, because you not like previous periods that following what these institutions do, because if anything happens you have the insurance, right? So that's the moral hazard with deposit insurance. Then the period also helped some relaxation of regulation, that is deregulation, right? So that facilitated further competition, right? So this led to some reforms, recovery, and enforcements being introduced. This is to kind of protect people who suffered, right? So some structural shifts in focus in the US during this period. So these acts you don't need to remember, but the type of activity that's generating with these challenges, that's what matters, right? Then again, with all these reforms, recoveries, enforcement, again banking crisis. You cannot, with all this regulation, supervision, deja vu, it's again, right? So you see that with all this deposit insurance and not necessarily to blame for these things, but then there were other elements playing a role. Okay, so moral hazard further expanding with things with safety nets, right? So when the government stand ready to say these too big to fail concepts that we discuss, we are not letting these agencies, or even if they don't say, the expectation built to the extent that governments would not let these agencies to fail. So because of that reason, even the management, the agents, principal agent, so they would take more, even at times of difficulties, they try to kind of expand risk taking. Because anything happens, right, they would be protected by safety nets or the too big to fail considerations. But if you gain through higher risk taking, higher return, you know, risk and return characteristics. Lower the risk, lower the return, higher the risk, higher the return. We were talking these things all and all again, right? So the mapping of financial crisis, banking crisis throughout the world, systematic is and non-systematic. To say that macro-driven, systematic is macro-driven, and non-systematic is often not a macro-driven, but particular consideration-driven. For instance, in India, the financial crisis, if not the banking crisis, happened towards the late 80s, was cooperative banking sector-driven. So there were elements where deposits were not necessarily backed with the loan structures. So there were cooperative kind of structures they had during that period. So the cost of these crises, these costs across different time periods varied. There were countries they have exposed to this type of crisis again and again. Latin American countries, right? They had these problems. The concerns were very much prior to financial crisis kind of picture here. Okay, so these bills introduced is to kind of to some extent deregulate and at the same time enforce reforms into the financial crisis driven. So I'm not detailing these things because these are very US specific. But message is clear. Message is very clear in the form of you have to factor elements of addressing risk and managing to great extent unnecessarily risk taking through these elements. So the Dodd-Frank bill is one of the pioneering piece of legislations introduced in US and followed by many other countries. Elements here are we have discussed capital requirement, these all rating, over-regulation consideration, this government-sponsored is too big to fail considerations, right? So these are the elements that we see in the financial markets and in terms of financial regulations, particularly with the recent financial crisis and their considerations. So with that note, I'm stopping this topic that we discussed before we move into the topic. Any questions? Right. So we will get to the new topic, that is structure and competition of the financial intermediary industry, mainly the banking industry. Right? So you probably have this handout also been shared, if I'm not mistaken. That's the case. You all have the handout available for you all. Okay. Right. So it's available. If not, you can follow up with IBSL, so they will have the handouts. But as far as I'm aware, they have already shared. So if you have any questions, you can again raise it. If not, you can write it down so we can follow up on that basis. So this structure and competition is also further moving into the financial intermediation, financial industry, main participants in the financial industry, that is the banks, how the structure and the competition has phased out in recent times, that kind of a perspective. And you know now itself, the operations of individual banks, I mean, generally across the world is no different, right? There may be specific differences that depends on the level of advancement, level of development in the financial markets, but principally the operational structures of financial intermediation is not that different. Okay, they earn profits through financial intermediation. Okay, yes, again, in most countries, maybe in US it's not the case, but in most countries, even in the case of Sri Lanka and in other Asian neighbors and in East Asian region, even in Europe, you probably see a few banks. They dominate the banking industry. Although you may have number of banks, but few banks dominate. Okay. But in the case of US, there's a little more diversification to that conclusion. They have more institutions and diversified type of economic activities that they engage. They focus on commercial banking from a different perspective to more specific saving and loan associations. Then you see you can see also mutual funds. Mutual funds, that is in Sri Lanka unit trust. still it's not taken off. It's there for a concept as such, but we don't see unit trust have taken over any meaningful share of financial intermediation in Sri Lanka up to now, right? So unit trusts are pooling small timers investments and act like a little big individual, but the management cost and other elements, of course, eat into the operational cost structure. So that's not necessarily that popular. Then you see credit unions. These are very much specific credit purpose driven organizations. That's kind of a facilitation that you see in US. So US has little more diversified structure, maybe to some extent the advancement in infrastructure and the complexity of different type of economic activities, and also linkage with rest of the world as the a financial center to some extent, New York, and then of course different major cities in US. So would have helped to have this diversification more intact in that sense compared to other markets. They are still, I mean, dominant financial intermediaries play a major role. But yes, there are other centers in Europe, Asia, even in Middle East. The expansion is happening now. Expansion is happening even at financial centers, right? Some might say, what about Singapore, Hong Kong, London, Frankfurt, Dubai, Mauritius? These are financial centers, and even financial, I mean, the port cities also looked at, but very long way to go on that basis. So to say that these elements being brought into the equation, right? So in this section, we start by examining some historical movement in the banking system and how financial innovation. You see, innovation is good from one perspective, but at the same time, you have seen that has created unnecessary headache in terms of too much innovation during the financial crisis. Okay, so contributed to competition for sure, and fundamentally changed the bank operates. That is also true. The innovations, even ICT, people now don't wanted to physically have access to banks. You know all that. Now with the pandemic also giving another dimension to the banking or financial intermediation. So to say that these developments, okay, we go to kind of a commercial banking and then discusses some thrift. These are thrift means saving. In US, saving is also fashionable, right? Because some countries, they don't have established pension systems. Okay, so there are saving focus there because after retirement you have to live. So they manage these savings in a way through these established arrangement. Okay, so you have saving and loan association, all these mutual and unions that we were talking. But in the complex structures of these mixture of these agencies, commercial banks everywhere remains the largest component of the financial market, right? In some countries, more than 95% is held by commercial banks, but generally in advanced economies, 2/3 of the depository base of that country rest with these commercial banks. Okay. Also, we look at the concepts of international banking experiences and some recent innovations. These elements are good for you to kind of, have short notes in terms of some of the questions raised in recent times. That's the focus of our discussion today on this topic. Any question? There's a request whether to share the presentation. I mean, presentation is I'm putting the screen, and of course the IBSL has already shared, and if not, anyone can just send an email to Kavindra, so he will quickly share with you that details also. He asked me to share if anybody has a problem in accessing the presentation. So to say that the banks, the beginning of banks in UK, because prior to US being the center of financial markets, UK was the center up until maybe towards latter part of 19th century, that is 1800s, right? So prior to the World War One, of course, still London was kind of a center from a various perspective. But to say that before the Christ, I mean 1800s BC, banking was visible in Babylon. There, the moneylenders made loans to people to great extent. Okay. At the same time, then there were traces in the documented history in Greece and Rome. There were loans and deposits kind of structures, and also the exchange and change money. But the form of money, that's a different question. There were some existence of that type of arrangements. The gradual collapse of Roman Empire and then related trade flows, to some extent again post the expansion of the banking or related financial kind of intermediation prevailed at that time. But then again, there was some revival in Italian towns in 12th and 13th centuries. And then, of course, the English, if not banking system, kind of financial intermediation again started expanding in the 17th century in UK. And this again links with goldsmiths. They were depositing their excesses with goldsmith for safety. And these goldsmiths, when they accepted deposits, issued a note, like a promissory note. Actually, it's a promissory note in that sense. They issued a note of acceptance of deposits, okay, and agreeing to honor at demand the sum, the quantum, or with some return also inbuilt. So that note itself become a kind of a document that you can exchange in the market for transactions. And that facilitated to some extent carrying costs in terms of huge pile of coins, and also these notes become easier and safer to store, right? Not like a huge pile of coins that's being used at that time, right? So the goldsmith began to lend the money deposited with them in return for a high rate of interest also. I mean, apart from the depository that they were facilitating, and a demand honoring those, whoever brings that note, it's a promissory note kind, so they honor those obligations. But at the same time, whatever they received as deposits, they also started lending with the return, at times with high interest rates. And that itself created a possibility that they could also pay a return to the people who deposited. And invariably, that itself attracted more people to save. So the base of the financial intermediation during that period more or less centered around these goldsmiths, right? But interestingly, the Bank of England, the UK's central bank, was formed in 1694. That's in the 17th century, right? So the main focus of establishing the Bank of England at that time was to provide loan to the government. UK government wanted their operations to be financed by their established central bank. So the purpose was that at that time. For that, the government paid 8% interest, right? And also given the Bank of England the right to issue notes, right? So the same time, Bank of England also allowed to lend money to buy and sell gold. So they buy gold, they sell gold, and gold also become part of storing assets, storing value. I mean, prior to that itself, it's prevailed, but more or less it's become formalized with the arrangement. Bank of England was taking this over, right? Interestingly, until 1833, although the Bank of England was issuing, they have given the right to issue notes. Until 1833, there were simultaneous structures prevail, but in 1833, the notes issued by Bank of England was made the legal tender. Right? Prior to that, even the private banks were issuing some type of notes in UK, and that was accepted in transactions. Then you see the US introduction. In US, the American banking system, one argue, more competitive and therefore more economically efficient than other countries. There are arguments for this. Yes, there's a possibility because the banking system was started thriving in US mainly towards the early part of latter part of 19th century and early part of 20th century, right? So to say that some modern, if not efficient, ways of handling financial intermediation was already built across the world by that time. So you don't need to reinvent the wheel like some countries in Rome, in the UK, at early places that they went through. So you basically started with the wheel in place and you can develop the vehicle. Prior to that, you had to have different modes of wheels to be established to make it efficiently running. Right, so that is advantage. But interestingly, I'm just comparing some of these numbers with the levels prevailed in 2011, because I wanted to show you some expansion in recent times. The numbers are here, but as I said all throughout, some diversification of different type of institutions rather than concentrating in commercial banks was there in US. Commercial banks, saving and loan association, mutual funds, credit unions was very much there. And the size of these institutions, big institutions were few, right? And then the medium-sized institutions were the majority, and smaller kind of institutions also prevail in US. So that's why at the very beginning I said rather than 4 or 5 major banks concentrated to run the entire financial system in some other countries, there's some diversification in US. Because smaller ones, medium scale, then bigger ones, all there, but bigger ones are not necessarily dominating a huge pile of US financial system, right? So that has its merits to a great extent, right? And in the case of we will get into some details now. The the banking system started towards latter part of 18th century. There were controversies over the chartering of banks for various reasons, because US was a collection of states, United States, right? So, the National Bank Act in 1800s kind of given a structure federally. That means national banks, not state concentrated. I was mentioning state banks, national banks, international banks. So the state had the rights, but at the same time, they also given the National Bank Act the creation of federally chartered banks, right? So the comptroller of currency was there. Then they had the dual banking system, right? That means you operate in your states where you are located, like a province in Sri Lanka, but outside states you also operate through a national, if not federal. So that's exists in US. But interestingly, the central bank in US was established in 1930. It's in the 20th century. The Federal Reserve was established in 1930. Look at the UK, it is 1694. Okay, so that's very much in 20th century, little prior to the First World War. So this again shows the elements that we discussed in the US case. You can check the timeline. I'm not trying to explain here. But gradually expanding beyond the state boundaries to federal, and then of course gradually exposing themselves to the international direction. And you know, in 1929-32, the Great Depression, we discussed those stuff. That created so-called panics among those financial intermediation in US. So that give way to creation of FDIC, Federal Deposit Insurance. So to create the trust, confidence among banking industry, so to say, they have brought in the deposit insurance, right? And also try to separate banking versus securities business. Because at times, letting them, this is a competition, they control competition. They separated the banking and securities, because securities is assets. So they themselves create demand for assets, and thereby increasing the prices, decreasing the interest rates. So that itself paves them the capital gains. So the banks could act as a collusion to push the interest rates down, and thereby making benefits irrespective of the other fundamental economic considerations. So to say that they had the separation of banking versus securities industry. So these are 1933 developments after the Great Depression. I mean, this is the tail end of Great Depression into 1932. So these developments came. Okay. Now we are more or less moving into broader. You got a kind of a feel about how the banking industry in those markets kind of came into focus. We will move into more regulatory aspects now. Any questions before I move on to that part of the discussion? Right. So you see, you have in US, even with the establishment of the central bank, that is the Federal Reserve in 1913, they have not abandoned, if not closed down, state banking authorities. Different states in US have different authorities running their financial intermediary related regulations. Federal Reserve is the centralized central bank operation, but we will get into greater details of Federal Reserve and how it operates when we come to the central banking aspects. And with that, I compare Sri Lanka's our central banking structure also when we are discussing the Federal Reserve. But what is interesting here is they have both centralized Federal Reserve plus state bank authorities looking into some of these aspects. Then the state banks, which are under the state bank authorities, they also can become members of Federal Reserve System. They have dual regulatory consideration, but these dual regulations do not necessarily overlap one versus the other, but more or less reinforce the arrangements in place. But interestingly, having a membership with the Federal Reserve gives them a lot of scope in terms of accessing liquidity, lender of last resorts, other financing, and other related facilitation. In the case of US, the Federal Reserve also regulate the banks holding companies. There are subsidiaries, or for that matter, the main shareholder of certain type of companies are the banks. So the Fed also look into those companies' operations. Simply because you probably know the basic funds of those, if not the bigger share stake of these holding companies, would be the financial intermediary, and anything happens to these holding institutions ultimately challenge the balance sheets of those financial intermediaries. So the banks, so the Fed is keen on looking at it from a broader regulatory perspective. And then they also have the Federal Deposit Insurance Corporation, and this FDIC also provide deposit insurance to all the banks, but their key interest is to give insurance to state banks that are not Fed members. That means the banks who are within the purview of those state authorities and not Federal Reserve members. If they are Federal Reserve members, they have a lot of facilitations in terms of liquidity, lender of last resort, many other things that we were talking. That's the kind of the structure in FDIC prevail. And then state banking authorities also, as I was mentioning in the first point itself, also facilitating some of these state banks without FDIC insurance. These are smaller saving and mutual funds kind of structures in US. But interestingly, either federal, either state, or FDIC has been there for them to kind of fall back on difficult times in the case of US. Right. So the shadow bank. It's very interesting. I mean, shadow banking, these are the things that brought in with these developments in recent times. Right? So what the shadow banking is, it's the financial intermediaries involved in facilitating the creation of credit across the global financial system, but they do not fall under the regulatory oversight. Invariably, you can call it unregulated activities by regulated institutions as shadow banking. So to say that the below the balance sheet items in banks often falls under the shadow banking. They do banking kind of activities. They create loans, they create deposits, but unfortunately, this outside the regulatory purview. At times, those were very much through their subsidiaries, through companies, but at the same time, there are elements of some non-disclosed possibilities of engagement by these agencies. So the shadow banking is something which actually brought in with financial innovation, but at the same time, with the challenges in the formal financial intermediaries, this also expanded. To say that if the markets are not functioning properly, the financial intermediation gradually moves out from established markets, but the focus concentrates across some of the shadow banking structures. So that happens at times of financial stress and difficulties. One example in Sri Lanka now is, for instance, the foreign exchange market. They were talking of parallel markets, if not curb market, to say that the outside the established financial intermediation, there are foreign exchange transactions happening at different rates. So it's itself is a kind of a shadow arrangement, right? So this type of things establishes when you see stressors in the systems, because nothing but the developments in financial markets and the financial innovation happens because of profit motive. They wanted to make money. So to say that changes in financial institutions stimulate financial intermediaries for innovation, that brings them profits. I mean, in fact, greediness is good to some extent, because that brings in new way of looking at the same problem and try to address them. But more or less, if that happens with owners' capital, fair enough. But unfortunately, all these efforts happens with the depositors, if not third-party resources. That's the focus and consideration from a broader perspective. Right. So we can move on. We can move on and talk about financial innovation to some extent, financial engineering. Very, very interesting and still evolving and developing aspect. Today, if you look at most of the financial intermediaries and the treasuries, the senior positions are held by people who has experience, if not the learning, at least the basic learning in mathematics and to some extent science, not necessarily social sciences. Sometimes you see mixture of people, but these people who has learned in those areas are now increasingly moving into professions in financial industry. So they use mathematical techniques to solve financial problems. It's good. There's no argument with that. Right? They use tools and knowledge from the fields of computers, statistics, economics, applied mathematics to address financial issues, as well as devise new and innovative financial products. Effectively, this gives you a constructed solution to your financial considerations that you have. But the biggest challenge with this type of financially based products is the behavior of stakeholders in economies changes, not in the form of envisage models. That's behavioral, expectations driven, fear driven. You find tomorrow, the day after, there's a kind of a curfew, whatever. You try to kind of still stock some of this stuff. So your general financial flows that you wanted to maintain in your wallets, let's say you need 4,000 rupees per day for your living. So you keep 8,000 for 2 days. But when you see a kind of a curfew is established, probably you stockpile. So then you require additional. So the models would generally fit the 2,000 line, but this additional would create stress in the model. You can still factor that in and change the model. There's no argument in that. But generally, I'm telling you. So when everything established on this basis, try to kind of have breaching points because of human or the stakeholders' behavior, stakeholders' expectations. They expect, as I was mentioning, future inflations to be lower. You postpone your purchases because tomorrow's prices are lower than today's prices. If inflation is higher, you don't want to postpone. You buy today rather than waiting tomorrow. You expect exchange rate to depreciate. You import today rather than waiting next month. So upfront, right? So you find future interest rates are going to increase. You borrow today, right? And try to fix the loan rather than floating loan. So the behavior of the agents in economy is different. So financial engineering is definitely helpful. That builds these structures, nicely develop the financial products. But the ability of this type of elements playing a role is different. This is not lab experiments. This is not defined paths. These are variable paths. So the financial innovation, financial engineering, shadow banking, absolutely brilliant. But elements of risk associated with them is also significant. The collapse is very challenging. So that's what to some extent happened during financial crisis. Right. So we'll come to this point. Any questions before that? Right. So no questions from your side. So you see here the innovations in financial intermediation and financial markets due to changes or responses to changes in supply conditions, demand conditions. So we'll take demand conditions first. It is the people who demands financial products. So you need to devise or develop, innovate financial products to satisfy the people's or the agents, stakeholders' requirements. And some of these demand conditions actually arise because of volatilities in interest rates. You can't say today's interest rate is same tomorrow, day after, 1 year from now. Everybody knows that. What you have seen about a month ago is not the same now. And for sure, 3 months from now, 1 year from now, it would not be the same. So the interest rate remain volatile. It changes with other developments, associated macroeconomic considerations. Then, as I was repeatedly highlighting, the expectations of stakeholders. So to say that with these changes, you see, in the past, you might have seen the fashion, or if not the fashionable product in mortgage market is the fixed rate mortgages. And today also it's there. And today often people have a fixed rate mortgage when the interest rates are low. They just wanted to make sure, yes, I'm fixing my loan at fixed rate when the interest rate structure is low. The banks are not happy with that type of arrangement. They are worried interest rates would change, actually increase in the future. They are happy to fix mortgages when the rates are very high. Then the consumers, if not demanders, would not happy. So to say that the demanders and then of course the financial intermediaries' expectations do not match. Then they bring so-called adjustable rate, floating rate. Adjustable rate, okay, we review your a mortgage structure every 1 year. The rate structure would be mutually adjusted, if not financial intermediary adjusted, right? Every financial year. Or you introduce a floating rate. Rate changes with the underlying benchmark. Let's say 364-day treasury bill. You have the benchmark rate. That's the underlying principle. So the underlying principle would makes this rates to move with the changes to the underlying benchmark, as I was mentioning, let's say 364-day treasury bill rate. So the mortgage rate is fixed to the 364-day treasury bill rate plus a margin. Margin is same, but with the changes to the treasury bill rate, absolute payable rate for the mortgage also adjust. Right? So the flexibility has brought in here helps the financial intermediaries to make sure that adjustment takes place in line with the changes in the overall market conditions. Right? So initially, establishing a lower rate to attract customers also there. Subsequently, adjustable rate in line with the changes in the benchmark or whatever the underlying criteria makes financial intermediaries to recover that initial low interest rates that they provided to customers. So they call, okay, clients being asked to open accounts, and the initial 2 years, the interest rates would be very low. They fix it. But third day onwards, the rate is adjusted in line with this. The criteria is there. So they provide like that. So these are the ways through which the financial intermediaries market their products. But these changes in product in innovations have come in as a result of changes in demand conditions and interest rates volatilities. Then financial derivative products. Derivative is a security with a price that is dependent upon or derived from one or more underlying assets. Derivative does not have its own price, but its price derived from underlying asset. If it is facilitated by underlying assets of gold prices, the derived price varies with prices in gold. If it is derived prices from underlying stock price of XYZ company, the movements in XYZ company stock price would drive the derivative instruments prices. If it is underlying securities, government 5-year treasury bond, changes in the 5-year treasury bond would drive the derivative instruments prices. Okay, so this is a contract between parties to transactions. So the price of these derivative products changes with the fluctuations in the prices of underlying assets. And through this type of derivative instruments, you hedge your interest rates risk. Because with the underlying products interest rate adjusts, yes, your derivative instruments interest rates also changes. And payoffs, that means your paying cycles are linked with already issued securities. So the price is not arbitrarily driven, but through the pricing of demand and supply in the market. Right? So there are arguments then comes in, okay, why not somebody, right? These are insider kind of efforts, that's something else. But what I'm simply saying is the products being introduced to address the interest rate volatilities in the form of derivatives and adjustable rate. These are very common now in financial markets, and the people who wanted to have financial products also demand, because that's flexibility in terms of their returns from their deposits plus their obligations to their loans. Right. Then also from another perspective, as I was mentioning, not only the demand side, supply conditions. Today, the structures have significantly changed with developments in ICT. And nobody talks anything about credit card, debit cards today, because every account that you open often comes with these cards. And banks are discouraging you to physically come to the counters and exchange financial transactions. You can go to the counters for ATMs, automated trade transactions machines, right? So you can withdraw deposits, and they discourage smaller quantity transactions coming directly to the counters. And in a pandemic situation, that's also good. And that has now evolved to the extent touchless, right? Even today, the advertisements that you are seeing is not only the cards and all these type of things, but even touchless, voice or without touching the recognition of your cards through all the arrangements in place. So to say that the electronic developments have created a circumstance where more or less electronically the funds being transferred from one location to the other. And electronic banking has become, basically the virtual banking has become more or less the most sought after, especially during current global pandemic circumstances. So I'm not talking too much about these electronic developments because this is very common now, and I don't see, except very few banks, they still go with their conservative structures. But that does not mean they don't have, but that's to make sure some of their clients are happy with the existing. Even passbooks are now not fashionable. Those are electronic records that's been shared. But other elements like junk bonds, you have studied about this credit rating in our previous discussion. We discussed in detail about these non-investment grade bonds, junk bonds. So to say that only the investment grade countries can raise funds, no. The supply conditions have changed. Even the junk non-investment grade countries also can offer bonds, but you have to pay a price. Right? So you issue bonds which are high in credit consideration because low credit worthiness, because your rating is low, but you have to pay a price. So the supply side provides, and investors, if they match that return expectation on the basis of the risk that they are taking, they can buy. Then commercial paper. Commercial papers, that's the underlying financial flows being brought into the transaction here. So your receivables, your deliverables being exchanged through a formal, structural, contractual arrangement with the financial intermediary. You have rent receipt, you have mortgage payments, you can factor that in. So that itself become a financial products, put it to black and white, that's paper, and exchange in the financial markets. Then we discussed about this securitization when we were talking about this financial crisis. And securitization creates all this illiquid form of assets being pooled. And then, of course, financial engineering also plays a role. And then you form a security. And now you have a financial product. So, in a way that you create a market for non-marketable assets, which otherwise lie in the corners of financial intermediaries' books, into a reasonably marketable through kind of, the financial engineering talked of all the CDOs, all these other type of innovative mortgage products that we have seen during the crisis times and since then, is through securitization of assets. So this transforms financial assets into marketable financial capital market instruments, securities. And of course, there's a argument also here that has contributed to some extent in creation of subprime crisis in mid 2000s. But it's interestingly, the securitization cannot be taken out as a product that has contributed to this, because that also contributed to diversify risk and at the same time contributed to expand the market and access for houses and real estate properties for low income as well as other segments of the societies. But only thing is there were very loose supervisor regulatory enforcement considerations. Those something we have to address differently and say securitization is anyway help financial markets to introduce new forms, new ways through addressing financial considerations. And in financial markets, while these arrangements exist, these innovations expand, you also see the regulations being avoided through various mechanisms. In a way, these avoidance of regulation is not necessarily something they are acting illegally, but they are looking at these available structures and trying to avoid forcing themselves into those regulatory considerations. It's like you have taxes for some type of products. At the same time, you also have similar products available in the market which are not comes under the tax purview. So you go and buy the goods that are available without tax elements, and thereby do not pay that tax because you are not buying that product. So the operations and the outcome of usage would not be different, but maybe that taxing might have been introduced to discourage maybe some products which has been brought in outside, or to promote the products which are not taxed and available in the market for you to consume. Let's say domestic industries versus imported, whatever. So these are possible, right? So the competition for profit, as always there in the financial markets and every financial transactions, rational expectations, financial intermediaries look to skirt, that means to avoid regulations, and this is known as so-called loophole mining. You find a hole in the structure. So what you generally see is how banks have been asked to maintain a statutory reserve requirement, SRR. This is the reserve requirement. Every dollar or a rupee that you acquire as deposit, certain percentage of that, recently Central Bank of Sri Lanka increased that to 4% from 2%, effective 1st of September. You can go and see the Central Bank website, press release and details are there. The reserve, statutory reserve, the banks maintain in the central bank from the deposit base was increased. So effectively, when you keep a certain percentage of your deposits, that amount do not help you to earn money. So every 100 rupees you collect as deposits, you have to keep 4 rupees. So only 96 rupees is available with you to do your businesses, but you have to pay depositors for their deposits of 400. So in a way, reserve requirements, it's a tax on deposits, but banks know how to skirt these, right? So they bring in interest rate adjustments. Effectively, they say they pay for 100, but effectively they look at it to pay from 96 and adjust for other elements also, and they factor it in the form of like 90, like a 10% with liquid assets and other requirements they keep aside, and they work out the equation in that form. But in the books, yes, for 100 you get that. And from another perspective, you also see at times there are restrictions on interest caps. Interest being capped. You can't pay more than this. So then the people who wanted to have more return, they avoid the formal banking system. They go to all these kind of, unregulated shadow banking kind of structures. There they can get more return. But then remember, they're taking the risk also. That's why there is nothing called that's come free for you. You take more return, that means you are taking more risk. Higher the risk, higher the return. That's why from the very first discussion that we all had, I was repeating this as mantra. There are elements in financial markets you can't change. When you see somebody is paying you more, you have to accept the fact that he is taking some risk. That's why he's capable or possible to pay you. So you have to make sure that possibility is sustained by this stakeholder. Otherwise, after a point, you will lose your even the principal amount. So you have to have that discipline. You have to have that understanding, rationality, and also you should be able to educate your close one, your friends, and the societies, the underlying elements of risk and return. You are learning all these things not only to pass the examination, but also to say this being practiced in your day-to-day activities. So to say that when you have this restriction right on interest rates, then loophole mining, you try to avoid formal and you go to other. And also financial intermediaries, then they also extend goodies. But I think now there are restrictions for that also. They give you refrigerators, other kind of electronic gadgets, even sometimes foreign trips. I mean, you see minor accounts, they can't withdraw money up until they reach a certain age, right? So that's why sometimes parents open joint accounts and keep the control by one of the account partners. Yes, the minor would not be able to operate it until he reaches stipulated age of managing these accounts. So they get the gifts. That's the driver. So through which they try to avoid regulations. Then you see money market mutual funds. Mutual funds are, you see, the unit trust. The small time savers, they pool their small investments. If the volume is small, they cannot actually bargain for good price. So the mutual funds, what they do is they pool thousands of these small timers and they become one big fund and they go and buy. So then they can bargain, right? So that's also facilitate some loophole mining. And at the same time, there are facilities in financial markets to encourage these unit trusts, small timers for savings by extending credit facilities also, credit, no tax facilities, tax exemptions. So even normal funds that comes as reasonable sizes, the financial intermediaries pool them as mutual funds to get these tax advantages. Don't think the regulators don't know these things. They also know these things, right? So they also look at these as possibilities of loophole mining by these agencies. The sweep accounts, these are balances in transit. You have accounts until the balance get transferred from one account to the other. balances could reflect in both places. So this point of transition is a point of higher market value of the account holder in both sides. So it's in a way it's like a double counting, but it's now been addressed to great extent through very much electronic real time, real time. Then and there transactions get reflected in one place or the other. Right. Before I move into the next subtitle, the decline in traditional banking because of financial innovation. Any questions? You know, you all are now familiar with some of these stuff, so you don't necessarily wanted to go back to the the old, if not conservative or the traditional. I don't see even the traditional institutions who were very much doing some of those financial transactions and the modalities. Now they themselves expanded and introducing these innovative products, right? Still, I think postal saving structures prevail, but now because of all these developments, very rare few participants would be still continuing, but they could be doing it now. They are having difficulties to access because of the current pandemic kind of thing. So that also would contribute to more financial innovation in recent times and going forward. So the traditional banking activities, the financial intermediaries promote deposits to raise their financial bases and loan to create assets in their books. So this is the traditional financial intermediary functions. You accept deposits and you loan and you make money. That's the traditional banking, right? The financial innovation has contributed the traditional the bank's traditional banking functions to borrow funds, reasonably declining in recent times. You cannot rely only on such financing structures. And the gradual expansion of these financial innovation also has created a situation where the commercial bank's share of total financial intermediation has declined. Still, commercial banks the dominant force in financial markets, financial systems. Their share is gradually declining in recent years. But this being said, we don't see there's a decline in their profitability. That means they are making the profits from the expanding other kind of activities, financial innovation, and their proper, if not efficient, management of available resources. Interestingly, there is a increase. There non-traditional business activities are now contributing more to the balance sheets. So if you look at the balance sheet of any financial intermediary now, lending and borrowing based margin based income is not necessarily increasing, at least as a share. In absolute value, maybe it's increasing because of the volumes, but as a share of total earnings, it is not increasing. But fee-based, consultancy-based, commission-based, income from investment-based returns are expanding in balance sheets of financial intermediaries. So to say that traditional banking continues to be the base of financial intermediation, but financial innovation continuously expand their balance sheets and their asset positions and also profitability. Right. So this again shows the conclusion that we said commercial bank share of total financial intermediary assets. So to say that percentage of total credit across a longer time duration is actually not necessarily growing, but marginally declining in recent times in US from higher levels seen in 70s. At the same time, there's a fast decline in thrift. Thrifts is saving institutions. They call thrifts in US. Their share is fastly declining. This is partly because now these saving institutions also becoming state affiliated like, and now more or less these agencies also becoming financial intermediaries with new structures because they become advanced to some extent. But please remember, the largest fund in the world is Japan Post saving fund. That is having, I don't remember the asset size, right? Many trillions of dollars equivalent asset base, but still operates through the Japan Post is the Japanese postal system. It's a postal saving. That's how the households save. That system is fairly established in Japan with a lot of innovations, but in a sense that US savings structures are declining, that's going to the formal financial intermediation like banks, commercial banks now. But share of commercial banks also in total non-financial borrowings by other stakeholders is declining.
Western Union also came as the postal thing, no, sir? Way back
Can
then.
you repeat? Can you
The
repeat the question?
Western Union system also came as postal
Right,
financial method. Yes, I think.
right, right. You are right. In fact, that also came in and actually encouraged. But now Western Union is in fact used open to transfer funds and remittances being transferred from my worker points. So yes, you are right. Western Union is also a part of. It came as ICT based innovation, but with related other much more secured form of financial innovation. Now people are much more comfortable in having accounts being established in one location and electronically transfer. If you have a electronic banking, you can transfer from one point to the other. But at places where you don't have banking access, yes, you can have Western Union arrangements too. You are right. Thank you for pointing out that point. When you see cost advantages of acquiring funds, that's the liability side, because you deposit base or you borrow, that become a liability in financial intermediaries book. right? But at the same time, there are various forms of fundraising which has now enabled to access funds with a lower cost. Right. So the low cost financing opportunities actually help through financial innovation. Otherwise, you see with expectations in terms of interest rate behavior, underlying inflation-driven expectation. I said expectation, that's a inflation expectation-driven possibilities that actually helped to some extent the people kind of moving away from traditional banking when they do not get a real return when their inflation levels are rising. So they probably move into other forms of investing than traditional banking function. But financial innovation still tied down those people to bring in, because that has helped them to reduce these cost of acquiring funds and pay sourcing funds at lower cost levels. And then introducing other facilities. I mean, checkable deposits are often deposits with instructions. I mean, you write checks means you are instructing your bank to pay or do some adjustment to your account balances, right? So the much more expansion in terms of innovations have now declined this conventional type of financial products. Even people are now necessarily open to accounts for saving and check current account or deposits of fixed nature or time deposits. They don't separate it like you have a single account that has all the facilities. Like that's the innovation now facilitates its financial intermediation. And the use of funds, that is asset side, also had the income advantages through innovation. So you probably had diversification or segregation and things like that. But now the cost structures have narrowed to the extent where intermediation has become that competitive. You cannot necessarily segregate because you can access this information across all the financial products and easily compare. Okay, so the banks also got this technology-based initiatives to pool all different location-based advantages. So you do not necessarily only look at your branch, no, your entire bank's financial books as a whole, because your treasury systems are interlinked. Treasury management system, TMS, are so accurate that you know where the bases, where the funds are. So you don't necessarily require to borrow from your neighborhood bank. You yourself transfer from your head office to those, because centralized operation facilitate you to address these. So the information technology brought in innovations as well as sourcing as well as lending cost to be brought to a very manageable level and to a very competitive level where the banks are now benefiting through increased efficiency, and also from another perspective, this has increased the competition. Right. So we can discuss from this point banks' responses in our next discussion. That's a good point for us to stop our discussion today. We will also start more likely central banking with the Federal Reserve System if we get enough time next week. So I'm happy to stop at this point if you don't have any questions.